Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. And joining me to wrap up the week, we have Mark Marex. He's a specialist with the Index Research and Product Development team with Nasdaq. Mark, it's great to have you with us, and quite the comeback we're seeing in the Nasdaq 100 following Thursday's sell-off.
Thank you, Jill. Happy Friday to you and everyone listening. Great to be here. And yeah, I mean, I guess this was somewhat expected after really the worst day probably in almost 3 months for not just the Nasdaq 100, but the broader market yesterday. Thought it would be a good opportunity to talk about, what happened this week from a technicals perspective, and also to address the elephant in the room. I mean, we hit 10,000 for the first time, but it didn't really play out, I think, the way that a lot of people thought it might when we first hit that number.
Yeah, Mark, and let's take a look at your first chart here with relative strength and still continuing to see the outperformance there.
Sure. So, I mean, this is an interesting indicator, technical indicator, looking at 14-day relative strength at the index level. I mean, these measures for not just the Nasdaq 100, but a lot of individual stocks within the S&P 500, for example, as well, were well over 70, which is typically, the point of the index that denotes really, really overbought, overheated conditions. You can see on this chart in particular, going back about 3 years, we've breached 70 a few times, most notably at the beginning of this year, going through about the market peak. We had several readings above 70. Those levels are often, good signs to people, especially technical traders in the market, that things are getting a little bit ahead of fundamentals. We've had this great rally. Obviously, things have been improving from a fundamental perspective with reopenings in the economy and consumer spending picking back up, but kind of not a coincidence that as soon as we shot up to, above 70 this week, and we hit that 10,000 marker, it seemed like it was time for the market to take a breather.
All right, Mark, and I think if we take a look at your next chart here with the 20-day moving average, it's still quite remarkable to see the comeback that the Nasdaq 100 has made. I mean, in less than 100 days, we go from being at all-time highs to talking about a recession and a depression, and the market just seems to be pretty disconnected from what we're seeing in the economy, because if you look at this chart, you think nothing bad happened in between.
Yeah. I mean, there's been a lot of funny charts being shared, online in the financial community, just kind of taking out the drop in March and making you think that it's a sort of normal year if you just blank out that period. I mean, I think one of the most insightful analyses has been kind of talking about 2020 as almost an entire market cycle condensed into 1 year. I mean, people talked about how, March was maybe the longest month of their lives when it was happening. That's certainly been the case in the market as well, where, you had a late stage bull market in the first part of the year. Then you had this really nasty, almost mini financial crisis and bear market in March. And then you had a robust recovery in April and May. And then towards the end of May and into June, you had what was really sort of like a late stage market again, with a lot of kind of speculative behavior, people trading in certain assets that were really getting disconnected from fundamentals. The thing about this chart that's interesting is, when we talk about relative strength, that reading above 70, we've seen it probably actually less than 10% of trading days since the end of 1999. So that gives you an idea of, how common that indicator is to breach a level of 70. It's a little less than 10% of the time. For something like the 20-day moving average, the Nasdaq 100 was 46 trading days above its 20-day moving average going into yesterday. This has only happened a handful of times in the last 20 years. It happened in 2001, 2006, twice in 2010, once in 2014, once in 2016, and once in 2017. So again, you know, from a technical perspective, things, looking at this ratio, this indicator, we're also getting very, very ahead of themselves. And almost like magic, that blue line looking at the NDX daily close has dropped right back down right to its 20-day moving average.
And if you look at your next chart here, the SIBO equity put call ratio, what are you trying to discern from here?
So this is, you know, a bit of a broader measure. This is looking at all options activity on the SIBO, so not just Nasdaq-100 related. But, you know, what the options market tells us is, you know, how traders, investors are positioning in terms of their hedging, right? And if you look at where most of the observations on this chart going back 10 years lie, they're around that 0.6, 0.7 range. So about, you know, 70% as many puts in place as calls, which are, you know, looking for further upside and more bullish behavior from the market. Last week, towards the end of last week, beginning of this week, we hit a level of 0.37 in this index, where, you know, there was essentially close to 1/3 as many puts outstanding as calls outstanding. So an incredibly bullish, you know, positioning in the market with very, very little hedging going on. The last time the ratio was this low was back in January of 2011, and going back to September 2001. There have only been 9 trading days in total where the ratio was this low. So pretty spectacular from an options sentiment perspective as well.
All right, Mark, let's wrap up with your last chart here. NDX SPX ratio, taking a look at the Nasdaq-100 versus the S&P 500.
Sure. So this is one that I'll take a slightly different track. Some people like to use this ratio, which is just taking the daily close of both indexes and dividing them against each other. As, you know, as an indicator of market sentiment as well. I mean, it's interesting, again, that we did reach levels late last week, early this week, that were last seen in sort of the year 2000, March 2000 is when we got down to a ratio of 0.31, which is what we were seeing. But, you know, important to keep in context that the year 2000 was a very different macroeconomic backdrop. Things were getting right towards the peak of the internet bubble. The Nasdaq-100 was, you know, way less fundamentally supported in terms of its valuation. So on this one, I'm kind of acknowledging that people are looking at it and trying to keep it in context and say, you know, given the behavior of the Nasdaq, especially this year, it's not been the most, you know, out of whack indicator in terms of, you know, where market valuations are going. They're actually better anchored for tech stocks than most other stocks these days.
All right, Mark, great to have you with us as always. Thanks so much for joining me on Trade Talks.
Thanks a lot, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.